So we are in the paper of May 2021. Question 2, May 2021. Question number 2. So it says that Across Limited, a packaging company, is preparing its budget for the year to 30th of June 2021. In respect of fuel oil consumption, it is desired to estimate an equation in the form of y is equals to a plus bx, where y is the total expense at an activity level X, a is the fixed expense, and b is the variable cost per unit. The following data relates to the year ending 30th of June 2021. So we are given that the annual, total, and monthly average figures for the year ending 30th of June were as follows. We have the annual, total, the monthly average. So we are required to estimate the cost equation for the company for budgeting purposes using the following methods. So the first method is NAIROBI method. Using NAIROBI method. I told you NAIROBI methods. The format of the equation. The format of the equation is y is equal to a plus bx. Y is equals to a plus bx. Adam, you are saying that question is solved in class? That question is solved in class, is that so? Okay. So if that question was solved in class, then you can refer the notes. Good. You can refer the notes on that. Then I go to part B. Is part B solved in class? Part B, is it solved in class? Part B. It is also solved, eh? Okay. Then we go to question number 3. Question number 3. That one I'm sure we have not solved in class. We have not solved that in class. So then we can handle question number 3. Question number 3. So question number 3 then reads, Urada Limited is a manufacturing company based in the western part of the country. It has 2 divisions. One of the divisions within Urada Limited is currently negotiating with another supplier regarding outsourcing component A that it manufactures. The division currently manufactures 10,000 units of the component per annum. So we have a total cost of producing 10,000 components and the unit cost. Then we are told the above costs are expected to remain unchanged in the foreseeable future if Urada Limited division continues to manufacture the components. The supplier has offered to supply 10,000 components per annum at the price of per unit. guaranteed for a minimum of 3 years. If Urada Limited outsources component A, the direct labor force currently employed in producing the components will be made redundant. No redundancy cost will be incurred. Direct materials and variable overheads are avoidable if component A is outsourced. Fixed manufacturing overheads would be reduced by 100,000 per annum, but the manufacturing, whatever manufacturing cost would remain unchanged. Assume initially that the capacity that is required for component A has no alternative use. So based on that, you are told to advise the management on whether the components should be bought or made. On whether the component should be made or manufactured. So in advising that, the question is based on or is a make or buy decision. Make or buy decision analysis table. Analysis table. Analysis table. So what you do in dealing with the make or buy, you just deal with the variable cost. So the first one is direct materials cost. Direct material costs. Direct material cost. Obviously, we are analyzing per unit. As you can see, it is 120. We have 120. Then there is direct labor. There is direct labor costs. Direct labor costs per unit is 100. Then there is variable overheads. Variable overhead costs. Variable overhead cost is 10 bob. 10 bob. There is fixed manufacturing overhead costs. Fixed manufacturing overhead costs. Fixed manufacturing overhead costs, which you can see and the one that we are supposed to take is the one that is mentioned by information 5, the 100,000. The 100,000, it is going to be a relevant cost because we are told if you outsource, this cost will be reduced. That means it is only there when you are making. So it is a relevant cost, although it is fixed, but it's there only when you are making. So we are making 10,000 units. So this one you divide by 10,000, and that gives us 10 bob. That gives us 10 bob. So with that, we get the, or rather, following the table of the costs, The next one is share of non-manufacturing overheads. The non-manufacturing overheads, those ones will be there whether you are manufacturing or not. So they will not be considered as relevant costs. They are relevant. So at that juncture now, we have what we call relevant making costs. Relevant making costs. Add those costs and give me the answer. Relevant making cost is how much? Add that. Yes, 240. It is 240. That is the relevant costs. Then external purchase costs. External purchase costs. External purchase costs. There is somewhere we are told how much they will be able to get this item for. We are told they can get this item at a cost of 300. At a cost of 300. So that means you compare those two there. And when you compare that, when you compare those two, you finally come and make a decision here. The advice is that they should make the item. Make the item internally. They should make the item internally. It should not be outsourced. So make the item internally. Okay, then proceeding on to part two. Part two of the question says, assume now that the extra capacity that will be made available from outsourcing component A can be used to manufacture and sell 10,000 units of component B at a price of 340 per unit. All of the labor force required to manufacture component A will be used to make component B. The variable manufacturing overheads, fixed manufacturing overheads and non-manufacturing overheads will be the same costs incurred for manufacturing component A. Material Z required to manufacture component A would not be required, but additional material I would be required for making component B would cost shillings 130 per unit. Now assess whether the division of Rada should outsource the component. You assess whether they should outsource the component. So we can do that analysis here. You can do that analysis and say product A outsourced. Product A outsourced. If you outsource, if you decide to outsource product A, then what will happen? What will happen is, number one, you need to bring revenue received from B. Revenue that will be received from component B, you are going to sell the component at 340. So that is money that will come in if you decide to outsource. Then you now need to less. You now need to less the costs that will be incurred. One is purchase of purchase costs. purchase costs per unit of A. We are buying it at 300. So that one should be factored in, that we are going out to buy at 300. Then we factor in production costs. Production costs per unit of B. Per unit of B. The production cost per unit of B. The production costs, as you have seen, we will require materials. We are told that the materials will cost us 130. 130. We are also told that there will be labor. Labor remains the same. Labor remains the same at 100, just like we have here. That's what the question says. Then there is also the variable overheads. The variable overheads. Variable overheads. We are told that they remain. And the variable overheads, remember, we have 10. The variable overheads, remember, we had 10. And then the fixed overheads, they will also remain just like it was for A, which is 10 bob. That one would need to be considered because they will remain. And if that be the case, then you get the net profit. The net profit. So less those figures and give me the net profit. Subtract and give me the net profit. Subtract and give me the net profits. Okay, I can see the answer is minus 210. So then what advice do you give? Assess whether they should outsource. So the advice is that do not outsource. So the advice is do not outsource. It's not advisable to outsource that product. Okay, if you are okay at that point, type yes, so that I proceed to the next. Yes, Harrison, Mukami. Adam, Christine, are we okay? Okay, good. Let's now proceed to part B. Part B of the question says, the digital electronics company manufactures cameras and video equipment. It is in the process of introducing the world's smallest and lightest camcorder with 3D, HD, and SD recording modes. The company has undertaken a market research to ascertain the customer's perceived value of the product. The product's special features and a comparison with competitors, products and market prices have been used to establish the target selling price and projected lifetime volume. In addition, cost estimates have been prepared based on proposed product specification. The company has set a target profit margin of 30% on the proposed selling price, and this has been deducted from the target selling price to get the target cost. The following is the summary of the information that has been presented to the management. So we have the project lifetime sales volume in units, the target selling price, target profit margin 30%, target costs, and projected cost is 7,000. Before target costing exercise, the projected cost was estimated as follows. We have direct material bought in parts, direct labor, direct machining costs, ordering and receiving, quality assurance, rework, engineering and design, then manufacturing of marketing, distribution, after sales service, and that is the one giving us 7,000. Now the company then engaged a team to carry out a functional analysis of the product manufactured. After a careful analysis of the different elements, functions, and attributes of the camcorder, and potential customers interviewed to ascertain the values that may place on each of the functions, the following reports were given to management. 1, direct materials cost bought in parts to be reduced by a sixth. Direct labor should be reduced to 80%. Machining cost would remain the same as the projection. Ordering and receiving cost reduced by 75%. Quality assurance reduced to 5 out of 6 of the original estimate. Rework and engineering cost reduced by 90 and 20 respectively. Marketing, distribution, and after sales service and warranty cost reduced by those percentages. You are required to get the revised target cost. You get the revised target cost. So revised target costs. Revised target costs. So number one, there is direct materials. Direct materials. Now direct materials, it is that 900. We are told it is to be reduced by 1 out of 6. So it will be that 900 multiplied by 1 minus 1 out of 6. So give me that answer. Give me that answer. That's 250, good. That is the new cost. That's 250. The next one is direct labor. Direct labor. Now direct labor is 1,000. And according to information 2, it is reduced to 80%. So it is 1,000 multiplied by 0.8. That is how much? Give me the answer. Here's 800. And I need answers from everyone. We go to machining costs, direct machining costs. It is currently 800, and we are told, or rather 200, we are told it will remain. So you just put 200. The next one is ordering and receiving. Ordering and receiving. Ordering and receiving. It is 80, and we are told it is to reduce by 75%. So it is 80. So if you reduce by 75%, the bakisha 25%. So tell me how much remains. How much? Yes, good, Sylvia. Yes, I need answers from several of you now. Then quality assurance. Quality assurance. Quality assurance. According to information 5, it is reduced to 5 out of 6 of the original. It is 600. So multiplied by 5 out of 6. 5 out of 6, that would give us what? Harrison, Christine, I need your responses. Good. Yeah, I can see Sylvia and Adam. Good. Yeah. The next one is rework. Rework. Now, rework, we are told it is currently 150 and it is reduced by 90. So it is 150 minus 90. 150 minus 90, that is how much? That is 60. Then the other one is engineering and design. Engineering and design. Engineering and design. It is right now 100. We are told it is going to reduce by 20. So if it reduces by 20, yes, I can see we are left with 80. Good. Then marketing costs, marketing, we right now have 400, and we are told it is going to reduce by 37. So this will be 400 times 1 minus 0.375, 0.375. That is 250. Good. I can see the figure is running. Good. Yeah, 250. And then distribution. Distribution, we are given 300. And we are told it is reducing by that 3 1/3. So 1 minus 0.33. We can use 2 decimals. Let's use 2 decimals. 0.33. Yeah, I can see 201. Yeah, good. I only write an answer when we are 2 now, at least 2, so that I confirm. 201, then after sales service, it is 270. So 270 minus 80. 270 minus 80. Yes, good. I can see 190. 90. So based on that now, I should have the total costs. The total cost now. So add those costs. And give me the total. Yes, I can see 5,551. That is the total cost. The total cost. And remember, this is the one we call the actual. It's the one that we call the actual. Then the question requires us to get the cost gap. So cost gap, we must then get the target costs. Target costs. Target cost is already computed up there. It's already computed, and we were told it is 5,600. Is 5,600. So that means that the cost gap will be 5,551 minus 5,600. So that gives us a gap of what? That gives us a gap of 49. A gap of negative 49. Okay, I think that is okay. So we now proceed to question number 4. And question 4 says that PK Limited is a large public company in the telecommunications sector. One of its main planning and control tools is the preparation and use of traditional annual budgets. Whilst this may be appropriate for the sales and manufacturing divisions, it draws criticisms from the directors of divisions such as training and education, advertising and publicity, and research and development, who are responsible for large amounts of discretionary expenditure. These directors have submitted a joint report to the finance director, which suggests that zero-based budgets should be used for their respective divisions. The finance director has agreed to use the research and development division as a pilot for ZBB for the next financial year. Now, explain the meaning of the term ZBB. So this one you will copy from the handout that I gave you on budgets, or the notes I gave you, that ZBB, it is where everything is given a zero allowance until the manager is able to justify existence and benefits of those items. Until we are able to justify existence and benefits of those items. Then the stages that we are told to highlight, I told you there are 3 stages that are involved. You'll also get them right in your notes. Number 1, we said it is the definition of the decision packages. Decision packages pertains what is it that you want to do. It is about the activities that will be done. Then after you define your decision packages, step number 2 to Kasema, it is the evaluation of the decision packages. Evaluation and the ranking of the decision packages. And then after you rank them, you go to step number 3, where you allocate resources. So those things are right in your notes. Therefore, I confidently move to part B now, which says that Cryptomine Limited manufactures a single product K20 whose standard cost is shilling 7,500, made up as follows: direct materials, direct labor, variable overheads, fixed overheads. Additional information is that the standard unit selling price of product K20 is shillings 9,800. Monthly budget production and sales is set at 1,000 units. The following figures relate to the month of October 2020. We have sales, we have production, we have direct materials, direct wages, total variable overheads, fixed overheads. Now we are told to do actual profit and loss statement, then a flexible budget, and then we reconcile the reported variances. So budgetary control. So income statement. So in the income statement, we will have details. We'll have details. And in these details, we will begin with sales. Then we say less direct materials costs, direct materials costs. Then there is direct wages, direct wages costs. Then we will less variable overheads or the overhead costs. The overhead costs, we will have the variable ones, and then we will have the fixed. And based on that, we will report the net profits. We will report the net profits. Those are the components. So we start with actual results. Actual results. The sales, this question had some issues, some errors. The sales should be 1150. So rectify that. Should be 1150. So that now we say it is 1150 times 10,400 times 10,400 . Then, when it comes to the materials, when it comes to the materials, this is what we are going to do. The cost of the materials is 18,800 times 400. Times 400. That is the cost of the materials. But you can see the units that were produced, they were 1,200. But what was sold was 1150. So what you need to do is to divide this, first of all, by 1,200. You divide by 1,200. Then you will multiply by 1150. You will multiply by 1150 so that you get to know the cost of the materials. The cost of the materials. Then we will do the same thing with wages, that it is 5,800 hours times 500. You divide by 1,200, then multiplied by 1150. Multiplied by 1150. You do the same thing with the variable overheads. The 942,000, you divide it by 1,200, multiplied by 1150. Multiplied by 1150. So I thought there would be enough to be on the same paper, but it's like not. Okay, so give me the figures. Give me this one for sales, 1150 times 10,400. 1150 times 10,400. Yeah, 11,960,000. Good. Let us now go to the materials. Give me the figure for the materials. Yeah, 7,206,667. 7,206,667. The next one is how much? $2,779,000. 2,779,000. 167. 167. Haya, tuende kwa variable overheads. $902,750. 902,750. So the fixed overheads, those ones remain as given, which is 600,000. So now give me the profit. Give me the profits. 471, 416. $471,416 according to Sylvia. So if you have space, then for the flexible haina mambo mingi. Flexible. Now here, because the original budget is given per unit, we will not need to convert to percentages the way we normally convert, because it's just one. So we simply multiply the original budget by the actual units that were sold. So it will simply be a case of ukikuja hapa kwa sales, utachukua the budget, rather the unit that was sold 1150 multiplied by the budget price of 9,800. Give me that figure. Waiting for that figure. Yes, 11,270,000. 11,270,000. The same thing we do with materials. Material ukiangalia hapo juu, it is 4,000. So utanipatia 1150 times 4,000. 1150 times 4,000. Yes, 4.6 million. And 1150 times wages in 2,000. Yeah, 2.3 million. The next one is 1150 multiplied by 1,000. Yeah, 1.15 million. But now when it comes to the fixed cost, I told you fixed cost remains as per the original budget. So the original budget, according to information 2, was to produce and sell 1,000 units. So we will now use 1,000. We will use 1,000 times 500. So that gives us 500,000. That will give us 500,000. So what is the profits? Oh, 2.72 million. 2,720,000. So let's now reconcile. So profits reconciliation. Statements. Now, when the variances are based on the actual and the flexible, this one is simply you take the variances that we had. You remember when we began this topic of flexible budget, there is a column to the which was supposed to be variances. And those variances are simply these values minus these ones. So if the question is based on this, you simply take those differences and reconcile. It's as simple as that. So if that is true, we begin with budget profit. Budget profit is this 2,720,000. 720,000. That is the budget profit. Then variances. You can actually just start from here, sales price, or you just call it sales. So sales, utasema ni 11. If we start with actual, 11,960,000 minus 11,270. 11,270. So give me that figure. Oh, 690,000. Now this 690,000, because you can see the actual is bigger than the budget, this one is bigger than this, that is favorable. That is favorable. Let's go to materials. Materials, the actual was 7,206,667, while the budget was 4,600,000. The answer yeah, 2,606,000. I have 2,606,000, 667. 667. And this one, because you can see the actual is bigger, this is adverse. It is adverse because the actual is way higher than the budget. We got wages. Wages, according to, or rather the actual results were 2,779,167. And the budget was to be 2,300,000. So give me the figure. Yes, 479,167. 479,167. And you can see the actual is higher, so that is also then tuende kwa variable overheads. Variable overheads. Variable overheads are 902,750. 902,750 against 1150. Against 1150. $247,250. 247,250. And you can see the actual was much smaller, so this is favorable. That is favorable. Then we go to the fixed overheads. Fixed overheads. The actual was 600,000. The budget was 500,000. So that is how much? The difference. $100,000. And you can see it's advanced because we spent more. So based on that, we should now get the actual profits. The actual profit we got 471, 416. So we said what you do, you get the budget profit plus the deliverables minus the advance. You get the actual profits. The budget profits if it reconciles, you say yes. If not, you let me know. Yes, Sylvia says it agrees. So I think we are okay with that. We are okay with that. I want us now to proceed to question 5. Question 5 says, discuss the scope and breadth of environmental management accounting. Now, when you are told to discuss the scope and the breadth, that is a very wide statement or very general statement. We may not know exactly where it stops, but we can try to give some details about it so that we justify ourselves being awarded the 10 marks. So there you just write whatever you know about environmental management accounting. Environmental management accounting. And in that, I want you, number one, to write definition. Look at definition. So we can say for the definition, we write that environment management accounting addresses the management information, needs, the management information needs of managers, management information needs of managers for corporate activities, that affects the environment, as well as the environment related impacts on the company. That's one of the ways of defining environmental management accounting. It is about getting the needs or the information that the managers require to know so that they can be able to judge the impact of their actions on the environment. Like when I was telling you about when you print a paper, how does that impact the environment? When you use your car, when you are manufacturing and your factory is emitting those emissions, those smokes, those effluents, how do they impact on the environment? That is all about environment management accounting. But also, it is important to also get to know whatever happens in the environment, how does it affect your company? Like when there is drought, when there are floods, when there is sunshine, when there is no rain, how do that affect the company? So those are issues to do with the environment management account. Now, the other thing that you may need as you try to justify the mark is activities in environment management account. What are some of the activities that the managers may require to do? Some of the activities that they may require to do. One is identification and estimation of environment related costs. So as a manager, you require that to be able to identify and also to estimate what costs when we cut down a tree, when we use our cars, when there are emissions, when we even do mining and there are those derelictions or those unfilled holes that are left there and water accumulates there and there are mosquitoes and so on. How does that affect the environment? You need to know that as a management accountant. Number 2 is monitoring the use of environmental resources. Environmental resources such as water, energy, etc., to ensure sustainability. So it's like what I was telling you when you are using water in your house. You need to be able to ensure that there is a proper management, there is proper use of those resources, use of the energy saving bulbs, so that you ensure there is. Another one is inclusion of environmental concerns in capital budgeting decisions. So as you make a decision, maybe to buy a house, to build a house, to bring down a building, how does that affect the environment? When you are deciding to buy a machine, those are capital budgeting decisions. You need to assess that. Another one is estimation of environment related risks. What are the risks that the business faces, courtesy of what is happening in the environment? Those are things that you need to check. And something else that maybe you could highlight as you try to struggle for the 10 marks are the benefits of environment management account. How can the farm benefit? One, there is enhanced corporate image. So the society will perceive you as a good person, as a good customer, or rather as a good company who cares about the environment. And when people perceive you as good, then you enjoy the benefits that come from them. So you will have a good customer base. Number 2 is reduced costs or reduced environmental costs. So all those costs of the environment, they are reduced. Something else is avoidance of legal. Avoidance of compliance costs or non-compliance costs. Hii maneno ya kushinda ukishikwa na kajo, kushikwa na NEMA, kushikwa na those organizations that deal with the environment, or being accused even in the public or court, the public opinion courts. Those are some of the things. So what I have said is that there is a lot that you can write about environment management accounting, and that will justify you getting those marks. So are we okay with that? If we are okay, type the word okay so that I can proceed to the next. Alison ako sawa, Ada nako sawa. Sylvia Osawa. Monini. Christine, are we okay? Okay, so we proceed. I hope Christine is still in class. Can't see her response. So there is part B now that says the following information has been provided relating to the performance of XYZ. We have sales, we have profit before tax and interest, total assets less current liabilities. Additional information is that head office liabilities and net assets are to be shared equally between all the divisions. Division X spent 8.2 on research and development. Advertising amounting to that was spent by Y. Goodwill amounting to that was amortized. Cost of capital is 14%. The summary of borrowings, interest received and interest paid on borrowings is as follows. So we have that. So evaluate the divisional performance using EVA. So we are going to draw So we are drawing a divisional performance. Measurement. Statements. Divisional performance, measurement. Statement. We have details here. The company is divided into divisions. So there is division X, there is division Y, there is division Z, then there is head office, Just call it head. And then we have the company. We have the company. Once you are through with the drawing, click there, to add there. Once you get there, say there. Okay, we are there. So as you know, we always begin with what we have been calling conventional income. So conventional income. And for the conventional income, I told you you can begin with any profit, any figure that has the word profit. So we are going to begin with a figure that is called, with a figure that is given there as profit before interest and tax. So X has that 2, so you put that 2 here. Y has 24. Z has 25. And the head office has -9, and the company has 72. If you add them across, they should take you to 72. If you say that 2 plus 24 plus 25 minus 9, it is 72. Because that is for the company, we are combining. Then after that, you know, we quickly bring the adjustments. The adjustments. So there are adjustments that I mentioned. And in the adjustments, I told you there are 2 categories. One is the one that we do not document anywhere, but you should know. And of those that are not documented, it is the tax and anything that is in the head office. The ones that are documented, we mentioned things such as goodwill, advertisement, depreciation, research, non-cash, and so on. So in our question here, the very first thing that we can see is that the head office has a loss. So unless the question says otherwise, you should quickly share that. You should quickly share that. And according to information 1, you can see the head office liabilities and net assets are to be shared equally between all the divisions. So that also includes the profit and loss. So the head office loss, the head office loss, and because it is being shared equally, it will be minus 9 divided by 3. So here you bring minus 3. Even here you bring minus 3. Even here you bring minus 3. Here you bring a positive on 9 so that it disappears. We have removed it now from the head office and we have transferred to the divisions. The next thing is about tax. But as you can see, we have begun with profit before tax. We have begun with the profit before tax. So we need to know how do we respond to that. How do we respond to that? Now, this question has not mentioned to us the issue of tax. We are not told anything to do with tax, so that one we will just leave it out because the question has not mentioned tax. So the next thing that you can be able to see is the research and development. So we have research. Now research, you can see this company used 8.2. They used 8.2, that is division X. So this one, we say it should be added back. So you add it back there to the division, and you also add it to the company. So it should be added here, 8.2. According to the information number 3, there is advertisement. Advertisement, which we say should be added back. It should be added back. And it is 9.25 in division 1. So 9.25, which is also here. 9.25. 9.25. Then there is the issue of the goodwill. Goodwill should also be added back. Goodwill is found in division Y and Z, 65 million here. 65. Z, it is 97.5. So add the two of them, add the goodwill amount and give me 65 plus 97.5 is what? $162. Although I'm doubting those figures, they appear too huge. They appear too huge. Let's adjust them. Let's adjust them in the past papers. I think I need to confirm with the original. Naona kama hii ni too huge. So that we work with 6.5 and 9.75. That is too huge to be true. So then it will be 16.25. 16.25. Okay, then I think that is all. So with that, we have what we call revised income. Revised income. Revised income. So if you do the adjustments, you should be giving me that 2 minus 3 plus 8.2, that's 7.2. Then ukikuja huku ingine uniambie 24 minus 3 plus 9.25 plus 6.5 is that 6.75. Then 25 minus 3 plus 9.75 is that 1.75. This is 0. Then 72 plus 8.2 plus 9.25 plus 16.25. You should be giving me 105.7. So I think the figures are inaccurate. If they are, we now quickly bring the conventional capital. Conventional capital. So conventional capital is the figure that is given as total assets less current liabilities. So X has 140.5. Huyu mwingine ako na 121.5. Huyu mwingine ako na 118.5. Head office iko na 12, so that the company has 392.5. 392.5. Then you do the adjustments. You do the adjustments. You do the adjustments as usual. And as I've told you, you always begin with whatever is in the head office. So we are going to deal with head office loss, not loss, but assets. Head office assets. And because we were told that whatever is in the head office is shared equally among the divisions, then we will take 12, we divide by 3. So these ones to get 4, these ones also to get 4, these ones to get 4. Now here we subtract 12, so that equal to the here. We subtract that, equal to shatoa. Then from there, we bring what we call research. So research should be brought here, 8.2. And also here to the company, 8.2. We bring advertisements. Which is only in Y, 9.25. And then here in the company, 9.25. Then we bring goodwill. Goodwill is 6.5 here and 9.75, so that we have a total of 16.25. And with that now, we have what I will call, or what we call revised capital. We have revised capital. Revised capital. So sasa if you do the adjustments, utaniambia division X kuna 140.5 plus 4 plus 8.2. That is 152.7. Then 121.5 plus 4 plus 9.25 plus 6.5 is 141.25. Then 118.5 plus 4 plus 9.75 is 132.25. Ukienda huko niseme 392.5 plus 8.2 plus 9.25 plus 16.25, I get 426.2. 426.2. Okay, so if that is okay, I now proceed to have cost of capital. Cost of capital. And cost of capital, we are told it is what? According to information 5, it is 14%. So it is 0.14 of 152.7. So 0.14 times 152.7 is 21.378. Then 0.14 of 141.25. So 0.14 times 141.25 is 19.775. Then 0.14 of 1, that's 2.25. 0.14 times 1, that's 2.25 is 18.515. And you do the same commission, 0.14 times 426.2 is 59.668. So that finally you get economic value added. Economic value added. Economic value added. So huwa tunachukua the income that 7.2 minus the cost of capital 21.378. So you will get your answer. My space is squeezed. Then hapa 36.75 minus 19.775. Haya, huyu mwingine that 1.75 minus 18.515. Na huko mwisho, that one I can do straight as 105.7 minus 59.668. I record 46.032. So if you are okay, type the word okay. Yes, Adam, it's okay. Sylvia, it's okay. Yes, Harrison, good. Christine. Okay, so we stop at that point and pick up from there in the next lesson. Thank you so much.